So the VIX is always the place where you can go to answer the question, is this just a short-term pullback that I should be buying, or is it a level where I need to be careful of the market starting to roll over from here? All right, just wanted to record a quick video going over the VIX and how to use it. So the VIX is often touted as the fear index of the market, which is not super accurate, but it's a useful heuristic to be able to understand how to use the VIX in our trading. So this video is going to be mostly focused on swing trading, but I think you'll find that a lot of the knowledge is applicable even if you are day trading or doing longer term stuff. So what is the VIX? For those of you that don't know, the VIX is the Volatility Index of the S&P 500. What this means is that it is measuring 30-day forward implied volatility on the S&P 500 based on the SPX index options. What you'll notice is that the VIX tends to be inversely correlated to the market. So as the market is going up, and when we have these kind of smooth areas where the market is rising, you'll notice that most of the time this coincides with the VIX being relatively low. One of the first things you should notice is that when the VIX rises, when we have these little spikes in the VIX, this is when we tend to have sell-offs in the market. And this is why the VIX is known as the fear index, because as we get a move up in the VIX, it tends to coincide with the market pulling back. So you can think of it as the VIX measuring the amount of fear that's out there in the market. Now, if we look at a couple of special characteristics of the VIX, you'll notice that what tends to happen is we have a short-term spike up, which coincides with a short-term drop in the market, and then a move right back down on the VIX, and the market tends to recover. When we have elevated levels of the VIX being up around 20, 30 for extended periods of time, that's where we have longer extended pullbacks in the market. So we're going to talk about where the VIX is today and what that means for the market moving forward. So let's go ahead and zoom in a little bit to 2026 here. Okay, so we're going to talk about a couple of different things. We're mostly going to be looking at the bottom down here, but you can always look up at the S&P 500 in the top half and refer to that in order to see kind of what's going on in the market at the same time. So one of the things to note is that we haven't really moved much in the S&P 500. Since the start of the year, we've pretty much just been going sideways. And in that window, over that same period of time, the VIX has pretty much just been steadily climbing this entire time. You'll notice that it's kind of been finding a floor here at this 20-period moving average, which we'll talk about a little bit later. But there's a couple of key things that we have to note on the VIX that will inform us on how to trade effectively using the information that the VIX gives us. The first is the VIX levels themselves. So this is where the VIX is in relation to where it normally is. So the first level that we have to know is 20. And that is marked here with the buy the dip text, which we'll talk about here in a moment as well. So this level here, 20, is the first line that I have marked out here. And this is really the buy the dip line, as it says over here on the right. And what that means is when you see the VIX tend to make a spike up to 20, but not an extended move beyond 20, that is where we tend to want to buy the dip, right? We tend to get drops in the market on that spike up in the VIX. And then as soon as VIX fails to follow through on any higher moves, that's when the market begins to recover. It's a very good sign to go ahead and buy the dip. And we've been seeing a lot of that lately, but not a lot of follow through to the upside with the market. If we go back a little bit further, we can see these periods where the VIX has had increased spikes up above 20, and they have sustained for longer periods of time before falling back down to normal ranges. And that has coincided with the market staying choppier and a little bit more range bound near the bottom before eventually recovering. So there's a couple of things that we need to mark out. First is the 20 level on the VIX, but we also need to be aware of some other levels above that. So if we have some extended moves above 25, that tends to mark market panic. However, when we just have a brief spike to 25 and a drop back down, as we've seen the last couple of times here, it coincides with some big moves in the market, but ultimately some fairly quick recovery. Where we need to be careful is if the VIX starts having sustained moves above 25, above 30, those are some pretty extreme levels in the VIX. And so these are levels that you want to mark out. As I zoom back and we go back to the more recent drop here in 2025, you'll notice that it wasn't just a quick spike above 20. We had extended movement upwards above 20 into around the 30 area, coinciding with a rollover in the market. And then after a brief attempt at a recovery, the VIX started having some really strong moves to the upside that coincided with a large drop and these gigantic candles that we were seeing in April of last year. Then, as the VIX started to calm back down and return back to some normal levels, that's where we started to see the market begin to put in a bottom and start to recover from there. So the levels that I have marked out here, 20 being our buy the dip level, is for when we see some short-term spikes to that level. That tends to mark a buy the dip situation where we're not worried about the market continuing to roll over and fall down, but rather it's just a short-term pullback that we can buy for a continued move to the upside. However, when we see larger moves in the VIX, especially sustained moves to 25, 30 and beyond, that is what coincides with a larger downward move in the market. And that's where we need to be careful. So if we zoom back into what's going on today, how can we use that to understand what's going on right now in the VIX? Well, right now we've been seeing sustained increases in volatility for the past few months, and that has coincided with a really choppy market where we keep getting these sudden drops and then recovery and then sudden drops and then recovery, and it just keeps repeating all inside this range-bound area that the SPY has been trading in. If we look at some of these specific spikes too, we have some small spikes up that correlate with the market dropping, followed by the VIX coming back down and the market recovering. And then we get another move back up to 20 and you see the market drop, and then you see the VIX crash back down and the market starts to recover. And we've been rinsing and repeating that. And that leads to the second thing that we need to look at with the VIX. After we have our levels marked out and we're looking at specific levels of the VIX, the next thing that we can look at is the 2 standard deviation Bollinger Band of the VIX. So that's the other indicator that I've got on here. Now, typically what I do is I actually turn off the midline and the bottom line because we actually don't care about, one, the 20-period moving average of the VIX, but I especially don't care about the lower 2 standard deviation on the VIX. It's not a level that really means anything to me. However, the upper level is really what I want to see. So that's the line that I've got marked out in blue here on the VIX. So there's nothing special about this Bollinger Band. It's using all of the typical default settings. So we've got a length of 20. It's just a simple moving average that it's using for the basis and a 2 standard deviation band around that average. So nothing out of the ordinary then, but what we want to be careful of and what we want to look out for is both moves above significant levels such as 20, 25, 30, but also where the VIX is in relation to its 2 standard deviation upper Bollinger Band. So when you see moves like this above the upper Bollinger Band, that's when we need to be a little bit more careful. And what we're actually looking for is when the VIX moves back inside that Bollinger Band. So we had a brief move back in here where we might have had a quick recovery on that candle. The market tried to recover there, but ultimately it failed. And the next day we had the VIX moving back up and the market moving back down. So when we see this kind of failure to recapture and to continue trending back down inside the 2nd deviation Bollinger Band and below 20, that tends to coincide with the market having a heavier sell-off. Then when we do finally get sustained moves back inside the 2 standard deviation Bollinger Band, heading back down to and below 20, that is your signal that the market is starting to recover and we can be confident buying into the market at that point. Now, where the VIX is comfortable and where the market tends to have the most sustained bullish moves is when the VIX is below 20 and it's just moving around in the sort of mid-teens area. So around 15, 16 is typically a pretty low area for the VIX. About the lowest that the VIX ever gets is around 12-ish. That is extremely low volatility. It tends to coincide with the market not moving very much, or at least not in a very erratic fashion. But when we start having these extended periods where the VIX is hanging out around 20, that's where we need to be a little bit more careful. Now, right now, the VIX is not signaling that we're likely to have a market sell-off. Right now, it's just showing chop and a lot of back and forth action. So we're seeing that in the VIX, and then that is getting mirrored in the overall S&P 500. However, if we start to get sustained moves in the VIX above 20, and we start to see the VIX starting to hang out in around the mid 20s area and up to potentially 30 or some larger spikes here, that's going to be your signal that you need to be careful, maybe buy some hedges, get out of your bullish trades, and prepare for a little bit of downside action. That's probably where we'll start to see more sustained sell-off if we are to see that in the S&P 500. So the VIX is always the place where you can go to answer the question, is this just a short-term pullback that I should be buying, or is it a level where I need to be careful of the market starting to roll over from here? And 20 is always going to be your first clue to answer that question. If the VIX is just having a quick spike up to 20 and then failing, that's a buy the dip signal. And if the VIX is starting to have sustained moves above 20 or large spikes to 25, 30, and beyond, that is going to correlate to a more sustained move to the downside, and that tends to signal the market starting to roll over and go into a bit of a bearish trend. So keep an eye on those two signals, the VIX getting to 20 and potentially above, and also the VIX in relation to its 2 standard deviation Bollinger Band. If we're starting to see extended moves of both, we need to be more careful about the market potentially rolling over and turning into a bearish trend. But when you start to see the VIX moving back down inside the 2 standard deviation Bollinger Band, back towards and below 20, then that is the VIX telling you that the market is starting to recover and it's safe to buy that. Now, the last piece of the puzzle that we can add on top of this as just one additional filter to our analysis is the put-call ratio. If you've never heard of the put-call ratio, it is exactly what it sounds like. It's the ratio of puts to calls that are being traded in the market, and it tends to act as an inverse signal, meaning when the put-call ratio is really high, investors are really spooked in buying a lot of puts, and that tends to mark the bottom of the market. And the opposite, when you have really, really low put buying and everyone is piling into calls, that also tends to mark the top of a market, and we need to be careful of a potential pullback from that level. So that's just one more thing we can add on to our analysis. I'm not going to go too deeply into the put call ratio. If you guys want to know more about it, I can get further into it in another video. So let me know in the comments if you want to see that. Otherwise, we can go ahead and wrap up here with the VIX. So now you have one more tool in your tool belt as the first place that you should go to understand, is the market just having a quick pullback, or is this turning into more of a sustained sell-off? The VIX is the decoder ring that will help you decipher the market action. Thank you for watching. Don't forget to like and subscribe, and we'll see you in the next one.